Welcome, Steve, to our podcast. Great to have you on, Steve Parrish. You've got like 5 designations, including JD and a whole bunch of other things, so you are a smart guy.
Well, I appreciate that. We'll see.
You know, what I would love to ask you about is when people are getting close to retirement, obviously there's some things they ought to be thinking about, things they ought to be doing, and mistakes are made. What sort of mistakes are you seeing pre-retirees or newly retired folks making?
Yeah, I think really is the assumption that, hey, I made it. I get my golden watch, and I'm done.
I'm set, right?
I'm all set, yeah. And as being of a specific age, I'll let you guess what that is. The fact is, life does not stop.
Yeah.
Hopefully it doesn't stop.
Right.
And so really, retirement planning is kind of a 3-phase thing. It's what most people are used to, this whole, accumulating. Do I have enough money?
Yeah.
But they forget there is the act of retiring itself. You've got to figure out when you're going to file for Social Security. You're going to have to figure out what you can do with Medicare. What are you going to do with your 401k or defined benefit, all that. So that's kind of the act of retiring.
Yeah.
And then guess what? We don't all go off into the sunset. We still have lives after that.
Yeah.
How do you live out your retirement? So typically, people think of retirement planning as that whole accumulating wealth so that once you hit the magic age, whatever that is, I'm good.
Right. Oh, and I think you're right. So let's explore that. So, I mean, because I think a lot of people, when they think about retirement, it's a dollar figure. Mm-hmm. Once I get that dollar figure, or once I get this income level, or once I've got my expenses covered, I can retire. But what are other things people should be thinking about?
Yeah, part of it is you have to audit where you are.
Yeah.
Whether you're using an advisor or do it yourself, you really have to say, where am I? Then the other thing is really timing, because we keep saying retirement. It sounds like it's falling off a cliff. The fact is, and if I could give you a personal example, I'm on Social Security, I'm on Medicare, but I'm talking to you and I have a job. Am I retired?
So it gets fuzzy, doesn't it?
Yeah, so you got to first figure out what we mean. So a person leaving their employment, that's one thing.
Right.
But I would argue Social Security usually comes later if you can afford to do it.
Yes.
Medicare, there's a very specific age at 65 that you have to do things. So part of the process is figuring out which steps I have to take when. It's not you package them all up, you get your golden watch, and you ride off in the sunset. That's not how retirement works these days.
So let's talk about financial security through retirement. What do new retirees, what should they be thinking about to make sure they're secure?
One thing they have to think about is what they really want to accomplish in retirement. Now, it's probably a number, but I mean, what are you going to live on? Now, the old theory was, well, you could live on 80% of whatever your pre-retirement was because you aren't driving to work, you aren't buying suits.
Yeah,
well,
you hear that a lot, don't you? And we find a lot of people spend more in retirement because they have more free time.
And they discovered Amazon.
They have time to shop, right?
They have time to shop and do all the things they wanted to.
Yeah.
And so what you kind of go through, and maybe you've heard this term, but you go through the go-go years where you really catch up for all the things you want to do, and you take the kids to Disneyland and all that.
Right.
Then you get into the slow-go years where you don't go out to restaurants as often.
Not
that
quite
kind of
as
thing.
much, yeah.
And then you have a lot of people, unfortunately, have the no-go years where they're long-term care type of situations.
Sure.
Sometimes their expenses are really analogous to a smile.
Yeah.
They start real high, they kind of go lower, and then because of healthcare costs at the end, they go high. So part of it is to figure out, what do you want to accomplish?
Sure.
And because there are all the risks in there, because you don't know how your health is going to be and all that, how can you minimize some of those risks?
Right. So that's a great analogy. So when you think about that, your go-go years, you're probably spending more, you're probably traveling more, you're probably buying more things, more activities, and then maybe slow-go at less. Mm-hmm. How do you not overspend in the early years to hopefully maybe you spend less and then maybe more if you need long-term care? How do you think about that?
And this may be in the perfect world, but often if you have an advisor, what you'll do is almost have a contract where you kind of agree, okay, this is what I'm going to do. Understand, I want to go on that European tour with my wife.
Right.
Fine. Then you kind of figure out approximately what we're dealing with.
Sure.
If the market goes down, how willing are you to reduce your expenses by 10%.
Yeah, right.
And so really it's kind of a guideline that you come up with. You put guardrails on it as far as your spending.
Yeah.
And then you have this wonderful feeling of permission to spend. Because one of the things we run into, and I mean with affluent and high net worth people too, is they're sitting on a 401k plan. They don't know what that means because they don't know how long they're going to live.
Right.
So how much can I spend? By coming up with that, then you kind of got a permission to spend. You kind of figured out where you're going, but you cover your risks because you got to take care of longevity or dying too soon. Too.
Sure. I like that analogy of the guardrails because, I mean, that could allow you to spend a little bit more up front if you have certain guardrails, realizing that you'll probably have a period of time when you spend less. So
exactly, and especially
but let's say your go-go years just keep going till the no-go.
Yeah.
Well, you're just going to have to know you may have to tone it down a little bit.
You do have to tone it down, and also if the markets go bad.
Well, sure.
If you're living off a percentage of your net worth, and suddenly the markets go bad, that's guardrails go both ways.
Yeah.
It kind of says, okay, you have to lower it, but in the good years, and I mean, think of some of the past years we've had.
Sure.
That doesn't mean you have to increase your spending just because you've had a good run in the market, because markets turn.
Yeah, you bet. All right. Here's a big one, Social Security. A lot of people are depending upon it. Given the current climate out there, how should people be thinking about Social Security?
Well, none of us have the answer. That's obvious. And when we're talking right now, a lot is going on.
Sure.
But a few things to think about is the voting power of the American public.
Yes.
I still am comfortable, even confident, that we'll have some kind of Social Security system because it's such an important safety net. One thing that we do know is you can start at 62 or as late as 70. The longer you defer, the more you're going to benefit from it. Now, you tell me when you're going to die, and I'll tell you what to buy, I
I know
suppose.
exactly, right?
But the fact is, the break-evens on these are maybe age 80. So as long as you're going to live to age 80 or longer, it pays to wait on Social Security. Now, the question we get is, yes, but in 2033, it's going to go down 20%.
Right.
And right now it could be even more because of all the things that are going on with the government.
Sure.
We've done a lot of runs on that, and the fact is, everybody's would go down if it goes down.
Sure.
So it still makes sense to delay, unless you just know you're going to die.
Right.
So really, I'm telling people, don't overthink this. Right now, it's still a great annuity. It's still your base plan, and so sure, maybe you're going to get a haircut and on benefits.
Right.
But don't suddenly say, well, I want my money now because I can't trust the government. I don't buy that because I think the American voices will say, no, we got to fix this in some form.
Yeah, I tend to agree with you. And even if the trust funds run out, it's something like 73%-ish of the benefit, of the promised benefit we'd receive. And chances are they're going to fix some parts of it. There may be a little bit of haircut, as you said. But I agree with you. I think it's going to be there to stay.
I hope so.
Okay, let's switch gears a little bit. I know you've been in the life insurance industry for a while, and is there a role in life insurance in retirement planning?
Yeah, that's a question that comes up a lot because you usually think of you got to lose to win with life insurance.
Right.
You got to die, and then somebody else gets your money.
Yeah, right.
So retirement, I made it. What do I need this for anymore?
Right.
What I'm thinking is, at least in the U.S., the way the products are designed, they actually can be a very handy retirement tool. Term insurance, not so much because it's going to expire sometime in the 70s typically.
Right.
But I'm thinking of permanent insurance because it has all these tax advantages. Mm-hmm. So particularly with people that have some level of affluence, really cash value life insurance comes in handy because congratulations, you made it. You don't have to lose by dying to get at it.
Right.
You can borrow it. You could turn it into an annuity. What's really exciting these days is a lot of these life insurance products actually have long-term care provisions.
Right.
So if you have, we call it living death, I mean, if you have that need, instead of waiting to die, you can tap into life insurance cash values. So it's just that people kind of think of that as a thing you're done with at retirement.
Sure.
think of it as a death benefit with a whole lot of exit strategies. There's a lot of ways to get at that money while you're still alive.
Right. So you brought up a good point. So cash value, you can take that very often in a tax-free format. You can take too much though and end up in trouble. So let's talk about the pitfalls, what you got to look out for.
I would say a number one pitfall is who's watching it for you.
Okay.
A challenge I see is, let's say it's an insurance salesperson, they knew him from the golf course or church or whatever, they're the same age as the client.
Right.
They're retiring about the same time that the client is. The reality is there's things you have to do, mechanics. You got to change the policy around. You got to make sure, as you point out, you got to make sure you don't take too much out because then it lapses and you pay a lot of taxes. So I think the biggest pitfall is a set it and forget it mentality.
Right.
Doesn't work with life insurance.
Yeah.
Somebody has to monitor with that and mess with it at retirement. Otherwise, I'll withdraw my comment. It's good for a retirement planning technique.
Yeah, you can withdraw too much and then you're in a whole world of trouble. All of a sudden, this all becomes taxable and you may not have the money to pay for it.
Right.
Yeah.
And you don't have a death benefit if it lapses.
Right. Yeah, exactly. So yeah, you got to watch out for it. Okay, I'm gonna go off script here a little bit. Jobs, the Tax Cut and Jobs Act of 2017 is set to expire 2025. What do you think? Will it be extended? Will it expire?
Well, everybody's assuming it will be because of the situation we have in the White House and Congress.
Yes.
But it's a revenue killer. And
Right.
so I think what may happen is things like tax rates will be maintained, but there's going to be some things behind the scene they're going to take away. I know they'd like to get rid of the carried interest thing, which is
They've been talking about that for years. Yeah.
Maybe they'll get that this time.
Right.
Don't necessarily assume that the SALT deduction goes back.
Yeah.
I think it'll really be nuanced. So when people say we're going to retain everything from that, I'm not sure. I think they probably keep the 20% business deduction. I think they will keep the tax brackets because they're so obvious.
Right. Sure.
But behind the scenes, you don't, it's like sausages and laws, you don't want to see them being made. There's going to be some things to get revenue to pay for what they're doing there.
Right. Yeah, I think you may be exactly right. And it makes planning hard because we don't exactly know what the tax rates are going to be. But it does seem like, given the current administration, that there's some likelihood that in some format it's going to be extended.
Oh, there's an appetite for that. So, things like estate tax, we don't know. I personally think they'll keep that just for various reasons. But we don't know, but yes, I would agree at this point, at least the flashy things, the tax brackets, they'll keep.
Right. Well, Steve, thank you so much for taking time. Your 5 titles showed. You did a great job. We really appreciate you on our podcast.
My pleasure. Thank you. It was fun.
Thanks.